Hey everybody, I hope you're doing well today. So today we're going to talk about financial freedom, credit awareness, banks, investing, all of that stuff. So we're going to start with banks and credit unions. We're going to talk about predatory lenders, credit, how to establish credit, buying cars, investing, and even the FIRE movement. There is no reading associated with this week, so I hope you enjoy the lecture. Okay, so the first thing I want to talk about is banks versus credit unions. And I have listed here the top 6 credit unions and the top 6 worst banks. So let's start with the banks. These banks are listed through various sites for having bad practices, predatory practices, having sneaky fees, having things like that. So Bank of America ranks as the worst, Credit One Bank, Wells Fargo, Chase Bank, US Bank, and Citibank. So these banks will do things like change the due date of when something is due and then charge you a really high fee for not making the payment on time. This affects both your credit standing with the bank, and it affects your wallet because they'll charge you a fee, and it also affects your overall credit, which reduces how much money you're able to keep for yourself over the long run. The top 6 best credit unions in Orange County: New Vision Credit Union, Connecticut, Federal Credit Union, Schools First Credit Union. You have to be a teacher, know a teacher, or work within that industry. Alliant Credit Union, Navy Federal Credit Union. You have to be a military member, have a friend or family who can sign you up who's a military member. This is actually our credit union that we use, and we've been using them for 15-20 years. We really like them. And then Orange County Credit Union. They're really easy to join. Basically anybody in Orange County could join. And I'm not really sure about New Vision in Connecticut. Overall, if you're in a credit union as opposed to a bank, you're going to have lower interest rates with credit unions. You are going to have less fees, and each fee is going to cost you less. The ATM access, can be not as easy to access as a lot of banks. I think that's where a lot of banks get people. Chase and Bank of America are everywhere, especially in poor communities. And so people like the ease of access to ATMs, even though they might even be getting charged for the ATMs. They just like having that ease of access. So oftentimes banks fare better on that regard. If you are depositing money into a bank, it's not insured. So if something goes wrong, you may very well lose your money, but that's not the case with credit unions. Most credit unions are insured up to $250,000 for a deposit. Online banking and mobile apps. Now, historically, banks have been better at this, but in recent years, credit unions have made huge strides, and they're pretty much comparable to banks today in terms of being able to do your banking online and online apps. Service or friendly service. Today, you just have more access, I believe, to real people, to human beings, to talking to people either in the bank, or if you're going to pull a loan, or if you need a credit card or a car loan or a mortgage, you can actually go into the bank and talk to somebody. Now, there might be fewer banks locations or credit union locations than bank locations, but especially with those larger credit cards or mortgage loans, you're going to have less of an interest rate overall, so it may save you hundreds of thousands of dollars to be with a credit union versus a bank. And there's actually a lot less of those tricky financial predatory lending types of practices when you're pulling a loan or a mortgage or a car loan from a credit union versus from a bank. So you can go in there and not be worried that you're getting scammed or that you're going to be paying money that's unfair in terms of your ability to pay it back in your own credit. So historically, banks have been easier to join then credit unions, but it depends upon the credit union. Some of them are pretty good. You know, places like Chase Bank, for example, if you have $20,000 or $30,000 in there and you decide that you want to withdraw the money, I've heard of Chase Bank telling an individual that they were going to charge them as much as 25% for every $100 that they withdrew of their money that they had in savings. And so even though they can't do that, that prevented that person from withdrawing money from Chase Bank. So those type of misleading practices are reasons why you might want to look into a credit union as opposed to a bank. So one of the things that I found that students might not be aware of, or that people in general might not be aware of, is predatory lending practices. Now, Bank of America and Wells Fargo have been hit with huge fines over the past, in the past 5 to 10 years because of their predatory lending practices. But it's been around for quite a while. Things like payday loan locations and auto title loan locations, these are businesses that have have built their business frame on predatory lending practices. During the Obama administration, the laws were tightened up. You saw a lot of payday locations disappear because those predatory lending practices became illegal, so they weren't able to do their business in a lot of states. But then at the beginning of the Trump administration, a lot of those laws that had been tightened up or created were loosened again. And so you started to see in year one of the Trump administration towards the end, a lot of payday loan locations and auto title loan locations emerge again. So predatory lenders tend to use really unfair or deceptive practices. They do tend to target people of color, women, elderly people, so the very old or the very young, people who aren't necessarily certain what they're getting into. And they do target people who have good interest or good credit scores. They don't care what your credit score is, they will still charge you that very high interest rate. And this type of predatory practice that is an extremely high but deceptive interest rate, where you don't realize how much you actually have to pay until you get into the loan, traps people in a cycle of debt. They can pull out something like $500 and they're supposed to pay their loan back in 3 weeks, but because the interest rate is so high, they keep having to pull out an additional loan every single week, and they get stuck in a cycle of debt. So between that and people who don't have a bank or a credit union, people get themselves into some pretty hairy situations, and it's something you want to avoid. So how can you tell if a company is potentially a predatory lender? So they're going to charge very high fees. I'll show you in a minute how we calculate that, or how we can tell that the fee is really high, because a lot of times it doesn't seem that high, or it's very sneaky the way that they word things. And that's another thing. If they're hiding the fees from you, the actual APR from you, if you can't find it, if they won't tell you the APR, if they won't, if their paperwork is super long and complicated and you don't understand it, then you probably shouldn't be pulling a loan from that company. So they will charge high fees, they'll hide their fees. They always hide their real APR because it's an insane, outrageous amount. They will often want to access your bank account. So they'll say, well, write us a blank check so we have your account number, or give us access to your bank account number. We won't do any credit check, or give us your title to your vehicle to hold until you pay back this loan of $247. And this is how people get trapped. So they can pull money out directly, they can confiscate your car, and then people get into a really bad situation. So an APR is an annual percentage rate. Any credit card that you apply for is going to clearly state how much the APR is. And it tells you the total cost of the loan that you're pulling out or the credit that you're pulling out. So how do we figure out what to do? So a lot of times these payday lenders, they'll say, okay, we're going to charge you $100 on the $500 you're pulling out. And so you're thinking, okay, that's not too bad. It's about 20%. Well, let me just show you an APR. So for example, you borrow $500 and your fees are $100 over 21 days because you have a 21-day loan term, meaning you borrowed $500 and you need to pay it back. You need to pay back $600 within 3 weeks or 21 days. So what you want to do is you want to divide 100 by 500. That gives you your percent, 0.20. Then you're going to take that percent amount, 0.20, and multiply that answer by the number of days in the year. It's always 365. So 0.20 times 365, that equals 73. Then you're going to divide that number by the number of days in the loan term. So 73 divided by 21 gives you 3.4762. Multiply that by 100 to get your percentage, and that is 347.62%. 347% interest rate on that loan. This is why they're telling you in an actual number instead of the percentage, and it's so complicated to figure out. They don't want you to know that they are truly ripping you off. Even the highest interest rate credit cards or short-term loans at a bank are going to cost you at most 30%. And there's not going to be any additional tricky fees there. By the way, if you ever need to use this, you can just Google how to calculate your APR and it'll give you an example. Okay, so let's talk a little bit about credit scores, how credit scores work, what they mean, and how do you improve your score. So if you're 18, you might not have any experience with this yet. What you can do is you can start with one of those free apps to find out what your credit score is currently. You might not really have one, especially if you're very young. But the real the companies that actually monitor and create your credit score are Experian, TransUnion, and Equifax. So they have credit score monitoring themselves. They do cost money, but you know, I think that those are the most appropriate. No matter what you do, though, you should monitor your credit score always. You should kind of know what's going on. That really is money well invested. Even if you're using a free app, it's not as accurate as the Equifax one that'll give you all three, that'll give you your real credit score and gives you your credit history, gives you like what's hurting your credit or helping your credit. Those can cost like $10 a month, and not everybody can afford to do that. So you can apply for the free ones. It does help a little bit. It's better than not doing it at all. And it's always a good habit to constantly be checking your credit score. I would say when you're young, you should probably check it once a month. And as you get more, you know, just more mature, you have, you know, a little bit of time behind you, you know, once every 3 to 6 months is probably appropriate. And especially if you're older, you should, and can afford it, you should try to use one of those credit score monitoring ones like through Equifax that will, you know, monitor, kind of offer like a security in case something happens. So they offer different perks. So what's a good credit score? So good credit score is a really good, great credit score is 800 to 850. 850 is the highest you can get, really. A lot of those free ones, they inflate your credit score, so they're actually kind of wrong. It might say 800, but your real credit score is more like 700, so that's kind of a big difference. It's also good to know the difference between the category numbers, like what's a A plus, what's an A, what's a B, what's a C, because especially if you're young and you go to like pull out a loan somewhere, like a car loan or with someone else who's maybe kind of a predatory type of salesperson, they might tell you 750 is kind of a bad credit score. I remember being told that, at having about 750 as a credit score and being told that, they were going to charge me a higher interest rate because my credit score was not very good. Credit score of between 740 to 799 is actually a pretty decent credit score. It's pretty good. You should be getting, fair to good interest rates. 670 to 739, it's okay. You're going to start to see a lot more of those higher interest rates there, especially if you're younger or you don't have a lot of credit history. 580 to 669, you're really struggling here now with a poor credit score. And then you're really in a bad situation if you're below 579. If you're in the 400 or 500s, you're in a pretty bad situation. You need to make some serious effort to working towards establishing and enhancing your credit. So how do you do that? So one of the things that you can do to establish credit is to have a bank account or a credit union history. So, with my youngest son, for example, he was 12. We opened him up a savings account at Navy Federal. And when he turned 18, he went and applied for his first credit card, and they gave him, I believe it was $3,000 or $4,000 for his first credit card. And he was talking to his friends, and his friends were getting first offers of $500 to $600. The key difference there was not only was he not going through an outside credit card agency, he went straight to Navy Federal for his first credit card, but he also had at that point, I believe from 12 to 18, he had a 6-year credit kind of history with the bank of good banking practices. So it's not exactly credit history, but they had him on file. He'd never done anything inappropriate. He had been putting money in, little bits of money like his birthday money, all of those years. And so he had good banking history, and that really helped him out when he first started out. So that's one of the ways you can do it. If you're already 18 or 19 and you haven't done that, one, open up the credit union, but also you can try with like an introduction style credit card. Capital One and Discover card, those are good kind of introductory credit card. They'll give people like a $500 credit card or a credit card for somebody who maybe moved from another country, so they don't have a credit history. So you can start to establish your credit in that way. And I found that Capital One and Discover tend to be the most lenient for first-time credit card applicants. Car loans are a little more advanced, so it's kind of a catch-22. Yes, you should have a car loan at some point in your early life, but car loans can cost you a lot of money. Buying new cars in general, and the American consumeristic practice of buying new cars and then buying another new car as soon as you pay off that one, and then buying another new car, that is a recipe for keeping you poor. But if you are in your 20s and you have a good credit history and you have your 1 or 2 credit cards that you started with, getting a car loan in your late 20s to early 30s is not necessarily a bad idea, because you're building up the amount of credit that you're requesting, getting, and paying back, and kind of moving in the direction of maybe I could buy a house one day, right? Is somebody's going to offer me $5,000 and then $30,000 and then $400,000 in terms of, credit. Now, how do you establish good credit? How do you get that 800 credit score? So one of the most important things that you can possibly do is to maintain a credit to debt ratio. So say, for example, that credit card said, yes, here is $1,000. Now, if you want to maintain good credit or you want to increase your score, you need to use the credit card, but you need to pay it off and pay it down very often. You want to have a credit to debt ratio of approximately somewhere between 10 and 30%. Now, what that means is if I have $1,000 in credit from a credit card, I really should never hold a balance of more than 30%, meaning about $300. If you get $1,000 credit card or a $10,000 credit card and you go out immediately and you spend the full amount, 100% of it, either $1,000 or $10,000, it is going to drop your credit score. So that's first and foremost the thing that you need to know. 10 to 30%. You want to stay within that window. And it seems kind of counterintuitive. They offered me $1,000 in credit, but you're saying I can't use it? Well, you can, but if you do use it, you want to pay it off right away. And that actually helps really well. It helps your credit score as well. If you have $1,000 and you want to buy something for $800 and then you pay $500 that very next month, you paid it down back to 30% credit to debt ratio. And that means that it didn't linger in that higher credit to debt ratio. Of course, your payment history. So this is the one everybody knows. Make a payment every single month, even if it's the minimum payment. Never be late on your credit cards, and always pay on time, and always make a payment every single month. You don't have to pay it off every month, but you need to pay at least the minimum every month. Anytime you're late, even one day, it's a ding on your credit history, and it stays there for years and years and years. So your payment history with your credit to debt ratio and how much you owe overall, all of these are kind of percentage taken together like a pie almost, right? So how much do you owe overall? Well, you can owe a lot of money and still have a good credit score. But if you have a high credit to debt ratio, then it's going to lower your credit score. But they also look at credit differently depending on what kind of credit it is. If you have a house that you have a $500,000 loan on, you owe $500,000. But the bank and the credit unions and the credit agencies, they're very aware that that is a house payment. And so they look at that very differently than if you had $500,000 in credit card debt. So a car loan is looked at differently than credit cards. Mortgage is looked at differently than credit cards or a car loan. Your length of credit history here. So you want to actually open up a credit card fairly young so that you can have a history of credit. And that just simply takes time. There's not much you can do. So somebody in their 40s, 50s, or 60s, they can have 20, 30, 50 years of good credit history, and that's going to help their credit score. So your grandparents or your parents may very well have a credit score of 820, and you feel as though you maybe make more money than them, or you pay off your credit cards more often than they do, but they have 20 to 40 years of not making a mistake. And that's pretty key there too. There's not much you can do except for wait that one out. A credit mix is also considered. So if you have, people can have a lot of credit cards, especially these days. They say the average person has 7 to 10 credit cards in their wallet at any given time. And 50 years ago, that would have been considered insane. Nobody had that many credit cards, maybe one, if that. But today people do have a lot of credit cards, but they also might have business loans. They might also have, your mortgage, your student loans. You'll have a car loan. So a mix of long-term and short-term credit debt is taken into consideration when they determine your credit score. And then last but not least is new credit. So you can have wonderful credit, but if you go on a spending spree and you decide to open up new credit cards and buy a new car and buy a whole bunch of furniture and and do all of this stuff that you are opening up all of these new accounts in rapid succession, that can drop your credit score pretty quickly as well. So I hope that helped. What I really want you to take away from this is understand your credit scores, understand that your credit to debt ratio is probably the single most important factor in getting a good credit score once you have made your payments on time. Okay. So you would end up paying off $25,000 in 60 months, and your car payment would be $495 a month, and the total cost of your car loan would be $29,702. And with this particular car, that's not taking into account the $3,000 down payment. A carrot. I thank you. The $3,000 down payment and any tax, title, and license that you may have paid. So when I say cars keep you poor, what do I mean by this? If you took that same exact car payment and you invested that money long term in low risk or moderate risk investments, low to moderate risk investments like index funds, and you started with $3,000, so your starting amount was $3,000 because you had a $3,000 down payment for your car, and you paid $495 a month to yourself for investments for 5 years. Your return rate on average is about 7%. So that's actually fairly conservative. So we assume a 7% interest rate because interest in investments can go up really high and then stoop down really low and then go back up really high. So over the long term, almost everybody earns on average 7%, if not more. At the end of your 5 years, you would have $39,890 something, right? So your total contributions would be $29,702, so the same as you would for the car. At the end of that time, you would have earned $7,000 worth of interest for yourself. The downside is you'd probably be still driving around that old beater. You won't look as fancy, you won't look as cool, but you'll be on your way to financial independence. So what do I mean when I say cars keep you poor? That money that we spend, we do have to buy cars. That's especially true in California. But that money that you spend on new cars every single year or every 5 to 7 years, if you were investing that money and paying yourself, you would be moving towards financial independence and actual wealth, as opposed to one car after another. So let's talk just a little bit about investing. So I personally invest in through 3 companies. These are kind of those larger companies. They're not like fly-by-night companies. Vanguard and Fidelity tend to have really low purchasing costs, so they have low fees. And TD Ameritrade has decent fees as well, but I'll talk about kind of why we go through all of these. So in our TD Ameritrade, we have a mutual fund that we've purchased. We don't invest a lot in TD Ameritrade. It's a lot of like tech businesses and that kind of stuff. So it did really, really well last year and has absolutely tanked this year. Again, investments go up and down, so they can really kind of skyrocket and go down. Our Vanguard and Fidelity, they tend to be more kind of just, less highs and less lows. And we purchase index funds. So what are the difference between index funds and mutual funds? So a mutual fund, a company like TD Ameritrade, will take a whole bunch of companies and they pick and choose which companies they think are going to do best, and they package them all together, and then you buy stocks in that mutual fund. So it's somebody or the company that's making a decision that these are the best ones and this is the package that they're giving you. Some mutual funds start as low as $1 down. You can almost have no buy-in to get in, up to around $5,000. So you can have really small buy-ins, $5, $10, $100 for a buy-in for a mutual fund, depending on the company. Index funds, you're not buying into a pre-packaged selection that the company made. You're buying into the total stock market. So all of the S&P 500, for example. And what that means is you're looking at how stocks as a whole over time are doing. And we can look back in time 30 years, 40 years, 50 years, and we know that on average your return, and you're going to see an increase in the value of stocks if you look at it over the very long term, over 10, 20, 30, 40, 50 years. And so that average return on a very minimal basis, if we're being very conservative, we can say is at least 7%. In the past 10 years, it's been 8 to 10% easily. Last year for us, it was, I think, 12%. But again, they go up and down. The issue with index funds, though, especially with Vanguard and Fidelity, while their fees are really low, their first buy-in is about $3,000. So some of the companies can be as low as $1,000. But Vanguard and Fidelity, I think one is $3,000. I think that's Vanguard, and Fidelity is probably like $2,500. And that can be a huge buy-in, especially if you're young and you don't have a lot of money. But again, remember, a lot of people are willing to put a $3,000 down payment on a car. So are you willing to put a $3,000 down payment on yourself? This money's yours, right? So we talked about what it would mean to, pay ourselves for 5 years, and we would have made about $9,000. So say, for example, you did decide to invest in index funds, and you do that starting amount, again, of $30,000, and you do $495 a month for the first 5 years, and then after that you only contribute $50 a month for the next 35 years after that. At the end of 40 years, you'd have $180,000 of a balance from that one car. Think about what that means. That car could be the difference between you living on Social Security and you having a little bit of a cushion in your old age. And I know for many of you, you're not thinking that way now. You're just trying to get by. But I just want to show you what this means and what this could potentially mean for your future if you make that kind of decision. Now, when I talk about investing, I tend to be a very conservative person. You can buy individual stocks. Like, say, for example, you want to buy, you're young, right? So you want to do risky stuff. So you want to buy stocks in tech companies, or you want to buy stocks in marijuana companies, which you can, by the way, now, right? And you can make money off of that, right? So do you buy alcohol? Do you buy marijuana? Do you buy all these tech gadgets? Have you ever considered, instead of buying that new phone, you actually invest $1,000 a year in Apple instead of $1,000 a year on a new phone, and stick with the old phone, but invest that money in that industry instead, and try to make that money back and have those companies paying you instead of paying them? That's something that you should maybe start to contemplate in your youth, because you have the benefit of time. The way that you really make money in investments is over the long period of time. So the reason why I was saying other stocks and kind of high risk versus low risk, when you buy individual stocks, you personally are making that decision. And so your chances of losing the money or it, deflating are much higher, because your choices are not going to have the benefit of a 30 or 40 year history of the stock market that you would know. And so the safe bet is generally index funds and mutual funds second to that. So that's long-term investing as opposed to playing the stock market. By the way, that car would give you a total interest rate of $153,000 by the end of 40 years. Let's say, for example, you made a commitment for the next 40 years, and you decided not only to put that $3,000 down, but you decided to put in $495 a month, the cost of that car, for the next 40 years. At the end of that 40 years, you would have $1,355,000. You would be a millionaire. Now, you may have heard of this. This is called the FIRE movement, or financial independence, retire early. So the FIRE movement has something that they say is the 4% rule. So your goal is to invest as much money as you possibly can, as early as you can, to let that interest return back to you. And if everything else being equal and the stock market acts like it has for the past 50 years, you should get an average return rate of about 7%. If you never take out any more than 4% of your money that you have invested, you will never run out of money for the rest of your life. So let's say, for example, you ended up with about $1 million. You're pulling out 4% of that per year. That means that you are pulling out $40,000 a year and using that to live off of. Now you're thinking, I'm a millionaire, I should just be able to buy whatever I want. The goal here is to buy your freedom from being a proletariat. You're buying your freedom from having to work for a living. You're buying your freedom from ever having a boss again. And so $40,000 a year, what that means, you live frugally. You don't buy brand new cars all the time. You buy a cheaper home, you live within those means, within $40,000 a year. You lower your cost of living. You try to increase your income in your early years, and you try to invest as much money as you can as early as you can, so that you have the benefit of time. This means that your children will end up inheriting money from you, and you could spend a good portion of your life not having to work, right? So why do I do this video? We didn't have to do this, right? We don't have a reading on this. I have given this lecture numerous times in my classes, and people really, really appreciate this and want this. And all I can say, you don't have to take any of this advice. I try to keep it general. But I feel like we don't have a lot of places where we get to learn this kind of stuff. I've learned it over the years. I wish that I would have learned it very early on. But you know, if you even start to implement some of these things, you can make some really good decisions for your future and to help yourself out. So, you know, investing, look into the FIRE movement. Think about anytime you have to buy a car, that cars keep you poor and what that really means in the terms of the real cost of a car. You know, consider a credit union over a bank. Definitely don't use those fly-by-night non-bank locations or predatory lending locations. And I really do wish the best for you in terms of your financial health and your lifetime health. Have a wonderful day.